So our next speaker is ERNEST BOSHA from the Central Bank of Nigeria. He's going to be talking about regulating digital assets for financial stability and shared prosperity, which is a very timely and important topic. So thank you very much for making the time to join us here today. I'll let you take over.
Good afternoon, everyone. Good day from wherever you're tuning in from. I'm Bosha Ernest. I'm a policy analyst with the Central Bank of Nigeria, focused on fintech and payment systems, as well as digital asset regulation. Before the Central Bank of Nigeria, I ran a startup called CloudMab, where we built enterprise solutions for businesses. And I also advise startups around regulatory compliance, business expansion within the fintech ecosystem across Africa. And today we'll be talking about regulating digital assets for financial stability and shared prosperity this afternoon. Within the context of our discussion, we see digital assets as encompassing cryptocurrencies, non-fungible tokens, stable coins, CBDCs, digital bonds, and tokens. Throughout the day, I think I remember Clement spoke extensively about the digital assets ecosystem. We are very much aware of what cryptocurrencies are. We are quite familiar with non-fungible tokens and stable coins as cryptocurrencies that have stable value because they are backed by an asset with a relatively stable value. Although we've seen some stable coins that are backed using algorithmic mechanisms to maintain the stability of value. We are seeing CBDCs becoming more and more entrenched. SORA is integral to the Bakong CBDC project, and within Nigeria, we were able to launch our own CBDC, the eNaira, in 2021 October, and we've seen several jurisdictions. At least the BIS estimates there are up to 90 countries working on at different stages of their CBDC development. So that is also an interesting development within the digital asset space. We're seeing tokens, especially utility tokens, being able to give users access to privileged services and activities within very specific blockchain ecosystems. DAOs are currently part of the innovation around tokens. But the first question we would seek to answer today is, why should we regulate digital assets in the first place? And the charts we are seeing here seem to want to situate, first of all, the two-sided approach I've decided to adopt for answering the question, why should we regulate digital assets? The first has to do with the scale of growth, adoption, uses, and impact of the digital asset space over time, right? From the charts that we can see here, the market capitalization for the entire crypto market over time from January 2014 to this was November 2024. And then we're comparing that to the London Stock Exchange market capitalization within 2015 to 2024 November as well. And we can see that in 2015, the market cap for the crypto market was around $6.9 billion, while for the London Stock Exchange was more around 9.5 billion pounds. Now, we move forward 5 years later in 2020, towards the end of 2020, by the height of COVID and all that, the crypto market had grown to over $704 billion in market cap, while the London Stock Exchange had moved on to around 31.6 billion pounds. You can't compare that level of growth. And even the size, when the crypto market started, far lower than the size of the London Stock Exchange, but has grown significantly, multiples above the size of the London Stock Exchange. And as of today, we have the London Stock Exchange around 56, 57 billion pounds, and the crypto market, following recent events, been the market cap being around over $3 trillion. So we are seeing this significant size as a factor for why regulators and policymakers have become interested in regulating digital assets. And another angle to this development is even the number of crypto assets themselves, number of digital assets themselves, number of cryptocurrencies, and as well as the number of exchanges that facilitate access to these digital assets. Right. From the chart, we can from start to start, we can see around 2013, just 66 exchanges that they had on record. We go to all-time highs in early 2022 of around 10,397 different cryptocurrencies, and then by November 2024, we're around 9,935. Right. For exchanges, estimates from AAA says that there are around 564 exchanges in 2015, and there are over 1,800 exchanges as at November 2024. So not only do we see the growth in the size of the market, but we are seeing a diversity and diversification in terms of the number of asset types, and then we're also seeing a growth in the form of exchanges and platforms that facilitate access to these different asset types. And then we can also see the level of adoption is increasing at an astronomical rate. By 2018, AAA records that there were around 18 million owners of cryptocurrencies. And then you see a rapid growth. I tried to calculate this, and you're seeing around 99% cumulative annual growth rate for digital assets or cryptocurrency ownership, relative to around 8% for the traditional payment methods. We can see PayPal, we can see Visa cards, MasterCards, Amex card holders within the period. So we've seen the dimension for the size of the market, we've seen the dimension for the level of adoption, we've seen the dimension for the diversity and diversification in the type of assets and the platforms facilitating this access. And then we bring it more closer to within our own ecosystem, Sub-Saharan Africa and Nigeria specifically, where I serve as a regulator. And Nigeria is the most vibrant crypto market in Sub-Saharan Africa. And in Africa, Chainalysis and a few other platforms would estimate that Nigeria is the second most vibrant crypto market in the world, after the United States of America. And between June 2023 to June 2024, we saw over $59 billion worth of cryptocurrency being received within Nigeria. And there are different reasons for these increase in adoption. We are seeing the main drivers around macroeconomic instability. We are seeing drivers around the relative instability in the exchange rate of those countries, especially the weak domestic currencies. And then we are seeing rising inflation and high cost of inbound remittances driving the adoption of digital currencies and digital assets and cryptocurrencies specifically. And these reasons or these drivers are not just limited to Nigeria. They cut across all African countries, most African countries that have been surveyed by Chainalysis in this report. Another interesting thing is the size of transactions. Most transactions are small size retail transactions, around less than $1,000 per transaction as average transaction size. So that tells us that there are a lot of people using digital assets, cryptocurrencies for transactions, which range from remittances to savings to investment and predominantly driven through peer-to-peer transactions on centralized exchanges. And then, so we've looked at the reason or the rationale for why we need to regulate in terms of adoption, growth, and motivation for the users. The other part of the reason or the rationale for why we need to regulate has to do with the implications for financial stability, monetary policy, and the monetary system, as well as market conduct within the entire financial system. Now, when we consider currency substitution and cryptoization, cryptoization is a situation, especially when crypto assets are become substituted for domestic currencies and assets. And this leads to the circumvention of capital controls by jurisdictions, and then also leads to the circumvention of exchange rate controls. Specifically, this is facilitated by USD denominated stable coins, and we've seen a lot of these across for Nigeria and across most other sub-Saharan African economies. Another concern related to financial stability and monetary policy for regulators is price volatility and market risk. Now, for price volatility, we are aware that not only because of the inherent volatility of most crypto assets, which led to even the development of stable coins by innovators within the crypto ecosystem, but also the potential for loss of wealth and loss of livelihoods for unsophisticated is a major concern for regulators. And then liquidity risk, especially around the ability of exchanges to fulfill their obligations in a timely manner. Most of us maybe didn't consider this a significant problem, but we saw that with the collapse of Terra and with the collapse of FTX, where investors or just asset holders were unable to gain access to their assets. And then a major concern also for regulators is bank disintermediation. Bank intermediation is at the center of the modern traditional financial system. The ability of banks to be able to aggregate excess economic and financial resources and channel them to deficit areas or deficit sectors or deficit demand to be able to facilitate investments and lending is a significant aspect of the modern financial system. Now, the lack of intermediation mechanisms within crypto and digital assets poses a major concern for regulators. On the other hand, we also consider market conduct issues. Right? We saw these directly with the fall in FTX and a few exchanges, and even some banks that were linked to those exchanges, either holding back in assets, experiencing some turbulence within the time. So the pseudonymous or even full anonymous nature of cryptocurrencies especially also gives concerns to recourse mechanisms around dispute resolution for when transactions are not consummated based on the terms that are agreed. For instance, in Nigeria and in some other jurisdictions in sub-Saharan Africa, we've seen the adoption of peer-to-peer transactions, a significant adoption of peer-to-peer transactions. And within these mechanisms, the exchange provides the capacity for two transacting entities, most likely two individuals, to meet, choose and agree on a price, and then make the payment on the fiat side outside of the platform, right? So if there's a recourse for if there's a need for recourse, or if one party has not acted in good faith, the exchanges do not have the capacity or have not integrated the capacity to resolve such dispute. So that's the concern for regulators. And of course, in the underlying is always the concern around illicit activities, pseudo anonymity and full anonymity for on-chain transactions causes a level of panic, a level of concern for regulators as we are concerned around AML issues, terrorism financing, and proliferation financing as well. So these are the rationale for why we need to regulate the digital assets space. Now, moving forward, we also see a tension, right, between regulatory objectives and the digital asset ecosystem's motivation. Right, as we can see from the Bitcoin white paper, Satoshi says a purely peer-to-peer version of electronic cash, allowing online payments to be sent directly from one party to another without going through a financial institution. And we know for most regulators, especially monetary authorities, ensuring monetary and price stability, promoting a sound financial system, promoting employment, ensuring stable prices, promoting, maintaining monetary and financial stability are at the core of their objectives and their function and their mandate by law. And a system or a new monetary system that seeks to do away with financial institutions is fundamentally in conflict with these objectives. And then, of course, we also talk about Vitalik's white paper on Ethereum, talking about a Turing complete programming language that allows anyone to write smart contracts and create their own arbitrary rules for ownership, transaction formats, and state transition functions. Now, you can see how this is almost antithetical to the functions, the mandates, and the objectives of a central bank or a monetary authority. The monetary authority holds in most jurisdictions, holds the sole responsibility for setting rules for payments and for financial transactions. So a system that is built where anyone can create their own arbitrary rules of ownership seems to be clearly against these objectives. So that is where we situate the tension for regulatory objectives and digital asset motivation. However, there is a way out of the tension, right? And the pillars around these is to make sure that regulatory objectives are tweaked when they are being focused on digital assets to, first of all, have a bedrock of sound macro financial policies, and then there are clear legal treatment for digital assets with granular rules defining different scenarios, outcomes, and targets. And then, of course, effective implementation by using the right tools, the right technology, the right levels of collaboration, not just within regulators, but also with the ecosystem. Now, we've situated the tension, we've looked at the motivation for regulation, and then we have to consider what opportunities exist for digital assets to push and advance prosperity. And I try to look at them across 4 major segments. One is payment system innovation. The other is capital mobilization. The other is the opportunities around decentralized financing, and then enhanced inclusion. In Africa, there are over 350 million people without access to formal financial services, right? And as Dr. Olanrele said earlier, there are at least 28 million adult Nigerians, right, without access to financial services. Now, for traditional financial institutions, they might give different reasons or motivations for why they are unable to extend services to these unbanked and underserved segments. Some of them are the costs and operational requirements, for instance, of setting a bank branch within a remote or rural area. It doesn't make economic sense for them because their motivations and their end goal is to maximize shareholder value as a financial institution at the end of the day. So taking up the costly and operations heavy aspects of going to underserved communities to offer financial services might not make sense for them. So, but digital assets provide an opportunity in this regard, right? Within Nigeria and also in the Bahamas, we saw where the CBDC projects were able to take up the cost of providing offline payments in underserved communities. In the Bahamas, because of the location within the Atlantic, you have seasons where either there's a tornado or there's some natural disaster that cuts internet connectivity for significant portions of the islands. And then the Sand Dollar project was able to devise wallets that could function offline, and users could still continue to make payments until at a time where there was restored connectivity, and then settlement was done back on the online ledger. Within the Central Bank of Nigeria, when we implemented the e-Naira, we tried to create a USSD service for the e-Naira, where using unstructured supplementary data, even for just feature phones, users were able to not only create an account, but also be able to transact and receive payments through the e-Naira. This is something that digital assets and digital currencies make possible, and these can be harnessed to include more people within the formal financial system. And as we well know, when we include people, we are going beyond just access, but we want them to go to usage, and then the quality of the usage. Someone who has been included through the e-Naira can be able to start making micro pension contributions or micro insurance contributions for their small business, or even for their own personal healthcare. So that is the aspects around inclusion that we consider for digital assets to be able to promote prosperity. Now, within payments specifically, the advantage and the opportunity for cross-border payment innovation is the key function of digital assets with respect to driving prosperity. Now, in Nigeria and most of sub-Saharan Africa, if you try to send if Makamoto decides today that, he wants to send $200 to Ernest, right? If he sends $200, I'm most likely going to get $184 by the time it gets to me, right? Except he decides to send $208 or $210. That's the only way I would get $200 in full, because one, all the corresponding banking relationships and all the different payments processors and schemes between will take a cut of that money. And so on an average, 8% of total remittances are lost to these different stepwise payment arrangements that are in between, right? But remittances are significant for African countries and for sub-Saharan Africa. They are not only significant for the individuals who receive them to take care of basic economic needs, but they're also significant for the economies as a whole, right? Last year, 2023, sub-Saharan African countries received around $54 billion in remittances. Nigeria specifically received around $19.5 billion in remittances. And these remittances provide accretion to reserves for foreign exchange stability. And they also help drive investments back home, not only in terms of financial market instruments, but even projects, building businesses, and providing a form of social security through transfers to maybe less privileged family members that are back home and all of that. So we've seen several projects. The BIS has Agora, it has Mbridge, it has Jura, looking to be able to leverage CBDC networks, maybe through liquidity pool arrangements and other such arrangements, to reduce not just the cost of cross-border payments, but the time inefficiencies that are also associated with cross-border payments. So this is an opportunity that digital assets present, and to be able to advance prosperity through payment system innovation. For capital mobilization, we are seeing opportunities for fractional ownership and to reduce the threshold for investment in different asset classes that are currently outside the reach of most investors or most ordinary day-to-day Africans. We have use cases around certain innovators building platforms where through building blockchain-based platforms where they tokenize equity within startups, right? We have startup investments in Africa has seen a reasonable level of progress, but it pales in comparison to other jurisdictions. But innovators need financing, they need funding. So using tokenizing equity on platforms, reducing the threshold for investment can not only help the investors themselves get access to a certain asset class that they were, first of all, locked out of with the potential returns that they present, but also for the startups that are looking to raise funding, which is inadequate despite its increase over the last few years. They also unlock new avenues for raising capital that might not mean the significant loss of ownership equity that they might have if they were to go to venture capitalists or private equity funds. So this is something that we are seeing, and it presents an opportunity for prosperity as well. Decentralized finance has been, it has not taken off in a significant manner across sub-Saharan Africa, but we've still seen opportunities around access to credit, savings, investment options. And a key aspect of this is credit, right? We made a pilot within the Inera ecosystem where we programmed payments and then through smart contracts to be able to enable certain fintechs to offer credit to farmers. Now, for a farmer in a rural community in the far north in Nigeria who doesn't have a significant financial footprint, right, for traditional credit scoring, if they were to approach a bank or a traditional financial institution and say, "Oh, I want a loan to be able to expand my business," their chances of getting such a loan is very much close to zero, right? And that's because the traditional financial institution is looking at the risk profile of that customer, and it doesn't make sense for them. But through programmable payments, we're able to make it possible where the innovator or the fintech wasn't so concerned, because we knew that we had been able to program the Inera forward payments to make sure that, first of all, we programmed time for repayment. Secondly, we programmed a restriction around what the loan could be used for. So if they disbursed a loan for you to be able to buy input to buy more inputs for your farm, then there were certain merchants that could sell those inputs, where only when you went to such merchants to buy would your transaction be completed. So that reduced the risk profile that the fintech lender was taking on. And so we see that as more and more entities decide to adopt decentralized finance, there are opportunities around credit, around savings, around investments that can be unlocked for Africans and for Nigerians specifically. So now that we've seen this, how then can regulatory approaches ensure orderly and beneficial innovation in digital assets? We've seen that in most jurisdictions, especially within emerging economies, there are basically three lines of high-level policy options. One is an outright ban. So you have jurisdictions like China, Saudi Arabia, most of North Africa, outrightly banning cryptocurrencies or digital assets in a broader sense. You have certain jurisdictions that have more of a containment approach. Nigeria, for instance, has a containment approach. Mexico, Indonesia, Ghana, and some others, as you can see on the map. And then you have some that have decided to be more accommodative and proactive in regulation. So you have most of Europe. I'm sure all of us are familiar with MiCA regulations coming on board by December. You have South Africa, you have Brazil, you have Singapore taking an approach to regulate fully. For a research by the Atlantic Council, they surveyed 60 countries, and they saw that for these 60 countries, I think just 19 of them had comprehensive regulations for taxation, AML, CFT, consumer protection, licensing, and operations of digital assets, cryptocurrencies, and stablecoins as well. And especially for sub-Saharan Africa and for Nigeria as a case study, we are seeing a very significant uptake in stablecoins. And out of the, if you remember the fourth slide, out of the $59 billion worth of crypto transactions received, we also saw that around $23 billion worth of transactions within originating from Nigeria and within Nigeria are stablecoin based. So because of these, not only Nigeria, but most jurisdictions are beginning to look at regulations around focus specifically on stablecoins. The Bank of England and the FCA in the UK have published a few consultation papers around payment stablecoins specifically. We've seen the EU through the MiCA regulation. We've seen Singapore and other jurisdictions looking to build regulation around this. To continue, specifically, I have situated 5 basic approaches to ensure beneficial and orderly innovation within digital assets. The first is principle-based regulation. Now, this means regulators should not use a straitjacket to regulate a crypto. If you say or digital asset, if you say, all crypto is bad, so ban X. Okay, we think all crypto is good, so regulate B. Or we are not sure, so contain. It should be principle-based with flexible frameworks that are adaptable to different regulations. You could say, okay, if we see an issue with stablecoin affecting our exchange rate positions and affecting our capital controls, then we could build limits around not only issuance but transactions for stablecoins. If we see that global stablecoin arrangements are impacting us, we could say, okay, we would allow stablecoins, but we want them to be denominated in our local currency, or we want a mixture in the assets being used to back to be both domestic instruments and foreign instruments. So that flexibility and principle-based approach would enable regulators to harness the opportunities that digital assets provide while ensuring that innovation is orderly and does not lead to any macroeconomic instability or financial system instability issues that we identified earlier. Another is risk-based regulation. Within the traditional financial system in Nigeria, we've adopted a risk-based supervisory approach, and we're moving also towards risk-based regulation. And I think this can be extended to even the digital asset ecosystem. Proportional oversight should be based on asset type and risk, right? So we've seen this approach in Singapore. We've seen even in the consultation papers that the Bank of England has put out, we've seen that they've decided to also take this risk-based regulatory approach, where for instance, if a virtual asset service provider is combining both issuance, custody, and exchange services, then they have a higher risk profile, right? And they should be regulated with higher prudential requirements and other such considerations. If a virtual asset service provider is just a custodian, then they should have a different set of regulations from someone or from an entity that is combining multiple functions. So that's what we're talking about with respect to risk-based regulation. And then sandboxing and pilot programs are very important, right? The sandbox provides a controlled test environment to for innovators to come in, test their solutions, and for the regulators to be able to monitor and evaluate the risk potential and the reward potentials for these innovations. So we could put a limits around the number of users, limits around the values and volumes of transactions to be able to safeguard the entire ecosystem, while we also get to learn as regulators, and even the innovators themselves get to see maybe certain blind spots that they might not have envisioned when they were developing their product, right? And in Nigeria, we've taken this approach. I currently work with a team that runs the regulatory sandbox for Nigeria. It isn't for the Central Bank of Nigeria. It's not based specifically around digital assets, but we are having conversations around maybe creating cohorts for digital assets providers specifically. The Security and Exchange Commission in Nigeria recently licensed two virtual asset service providers, exchanges specifically, using an accelerated regulatory incubation program, right? And they would also continue through a regulatory incubation program that is more long lasting. And this approach has also been adopted in places like Singapore, as well as the United Kingdom by the Bank of England and the FCA. So this is another approach that can enable that. Collaboration goes without saying. Now, the collaboration is not just between regulators to share knowledge and understand the different risk and ways and systems of mitigating them, but it also has to do with regulators engaging the ecosystem, because there's usually a knowledge deficit between regulators and innovators. And popularly, everyone says, oh, regulation will always be behind innovation, but it doesn't have to be so, right? If operators and innovators are faster and ahead of the curve, the more regulators interact with them, the more we bridge that gap, that knowledge gap, that skill gap. And then cross-border collaboration is very important. The FSB, FATF have done a lot of good work in trying to set global standards for digital asset regulation. The travel rules by FATF, which requires disclosures of originating and recipient positions for cryptocurrencies, is a significant development that some jurisdictions have begun to adopt, and that helps to reduce regulatory arbitrage across jurisdictions. Clear legal frameworks are very important. Now, clear legal frameworks go beyond just regulations around AML, CFT, and all that, to even defining tax regimes. Now, defining clear tax regimes help in several ways. One, it helps in disclosure for the entities that are licensed to offer digital asset services. Secondly, for investors as well. We've seen cases like, for instance, in Brazil, right, where the tax laws have been updated to capture capital gains for crypto and virtual asset trading, where if you trade values of up to 35,000 reals, I think, per month, you have to pay capital gains tax. So it's a very clear regulation in the sense that it sets a threshold for the amount. It sets clearly what type of tax you are going to pay, and then how much based on the existing taxation system. So that also has an advantage, not just to the ecosystem for clarity, but even to the government. By putting clear tax regimes for digital assets, you also unlock a new avenue for revenue, right? There's $59 billion worth of crypto transactions coming into Nigeria. If you have clear tax regime, you can extract value from some of these. And currently, with most African countries approaching the World Bank, approaching the IMF for financing and for loans, maybe that is an avenue for them to also earn more, not only in terms of domestic earnings, but even foreign earnings, when you have global virtual asset service providers playing within your market. So that is these are the approaches that I would recommend as we seek to support orderly innovation within the digital asset space to be able to confer advantages and prosperity on the users within the ecosystem. This is more or less a case study for successful regulation. We see Singapore and then we juxtapose it with Nigeria. So for Singapore, crypto assets are treated as digital payment tokens and legally recognized as assets. And that means that crypto transactions are taxed in line with extant tax laws. Exchanges and issuers are licensed, and so they can also be taxed as businesses. The Payment Service Act was updated, and that's where cryptocurrencies were defined as digital payment tokens and given legal status. The Financial Markets and Services Bill also was updated, was enacted in 2022, and in there, the certain digital assets that were mainly for investments were given the same legal status as securities. And then, of course, they domesticated the travel rule through the notice PSN 02 within Singapore. Now, what this has done is there are lots of crypto exchanges, Crypto.com, CoinHako, Genesis, have registered in Singapore, right? And that means the regulators have better oversight. They can have access to data on activities because regulatory reporting is now required. And of course, we've seen a boom in investments within the crypto and digital asset ecosystem. Within this year till October, Singaporean blockchain and digital asset startups have raised around $409 million US. And if you juxtapose that against, or you compare that with Nigeria, Nigeria's approach has been more cautious. In 2017 and 2021, the Central Bank of Nigeria issued circulars to the ecosystem, to the financial system, warning banks and financial institutions from allowing cryptocurrency transactions, right, through their platforms. And this had an interesting effect. It had in two ways. One, it led to the increasing adoption of peer-to-peer transactions that we've come to witness in the ecosystem. Secondly, it drove most of the exchanges to set up in other jurisdictions. So some of them have gone to set up in the Seychelles, or gone to set up in Singapore, or gone to set up in the Bahamas. And of course, the country has lost that. But over time, there has been an evolution within the regulatory approach of Nigeria, not just from the central bank side, but also from the Securities and Exchange Commission. In 2022, the Securities and Exchange Commission issued rules on issuance, offering, and custody of digital assets. These were not implemented, of course, but they provided some level of direction to the industry. And then in 2023, the central bank issued guidelines on operations of bank accounts for virtual asset service providers. So this was to situate the banking relationships that could exist between virtual asset service providers and commercial banks in Nigeria. And then earlier in 2024, the Securities and Exchange Commission, through the Accelerated Regulatory Incubation Program, licensed the first set of virtual asset service providers. So I think now there are 7 virtual asset service providers in total that have an approval in principle to operate within Nigeria. 2 of them are exchanges, 2 are custodians, 2 of them are platforms. There's one platform offering a Naira denominated stablecoin. So moving forward, also recently there has been proposals from the government, from the federal government to the National Assembly for a tax reform bill, and within this tax reform bill, the government is proposing to have crypto and digital assets recognized as assets and then subject to capital gains and value added tax. The transactions in crypto or digital assets subject to value added tax, and then investment returns using digital assets subject to capital gains tax. So these are while Singapore has always been accommodative and more proactive. In the case of Nigeria, it has been cautious and has evolved from a little bit of a hostile position to more of an going towards an accommodative position. So, what do policymakers need to be able to adequately regulate digital assets for stability and prosperity? One is to build regulatory capacity in terms of skill, knowledge, and tools. Right? You cannot evaluate properly what you can't measure, and you cannot be able to adequately regulate if you do not have the capacity, not just the technical knowledge, but the operational knowledge. So trainings and resources are very important for regulators as they seek to be able to adequately regulate the digital assets ecosystem. Investing in monitoring infrastructure, there are several operators out there, Chain Analysis, Elliptic, etc., that have built tools that are able to help with analysis and monitoring of the virtual assets space, not just on-chain activity, but off-chain activity. Recently, the Bank of England, together with the BIS, working on Project Pax Trail, where they combine on-chain data and regulatory reports from licensed virtual assets providers, service providers, to be able to monitor the entire ecosystem of digital assets for the UK. Engaging stakeholders is something that must be continuous, right? Internal stakeholders across regulators, external and international stakeholders, the regulators with the ecosystem, and the ecosystem also engaging the regulators. Encouraging innovation, we could use sandboxes, we could use incubation programs to encourage innovators. If we have objectives, for instance, we have a financial inclusion objective, right? We can encourage innovation. We could create specific incubation programs that are focused on financial inclusion using digital assets. And as such, we can encourage innovation and maybe marshal or drive innovation towards use cases that help us as policymakers to reach our objectives. And then, of course, monitor and adapt. The crypto and virtual asset space is constantly changing, it's constantly evolving. So continuous monitoring and continuous adaptation as we see new use cases, as we see new technologies, we see new solutions building up, would be very important for policymakers to be able to adequately regulate the space. In conclusion, I think regulating digital assets for financial stability and prosperity is a game of balance, right? Balancing our regulatory and our regulatory objectives and mandates with promoting innovation that is beneficial to not only to the financial system but to the entirety of the people over which we have been given the responsibility as regulators, especially as central banks. So, in conclusion, yes, balance is the key word as we look to regulate digital assets across several jurisdictions. Thank you very much for listening.
No, thank you for the very interesting talk. And there's a few questions. Let's see. Yeah, one question is, have you seen any adoption of crypto for real economic activity, or is it mainly just speculation based on your statistics? I'm talking about for Nigeria.
So for Nigeria, we've seen adoption of crypto for real economic activities. One is remittances and cross-border payments, right? So even licensed payment service providers are leveraging stable coins to be able to fulfill cross-border payments for businesses that are looking to import. I as a regulator, I can't say names specifically, but we have innovators, we have some fintech providers who, I'll give you two use cases. One, in northern Nigeria, right, there's a significant Muslim population, and people go over to Saudi for the pilgrimage, right? every year, maybe 2, 3 times, 4 times in a year. And these guys, using stable coins, are able to provide you give them your naira, you go to Saudi, they're able to find you some Saudi reals on the other side because they have someone taking it off on the other side through the stable coin. You have some other innovators that are helping importers to be able to pay for imports from China, leveraging stable coins. China is a significant trade partner for Nigeria, right? So we are seeing actual real use cases around digital assets. I just give these as examples used for stablecoins specifically.
Yeah, it sounds like mostly in cross-border or international payments and things like that, remittances. I think that makes sense. And of course, there's lots of speculators. So you pointed out there's a lot of sub $1,000 transactions, and
yeah,
these are probably people kind of gambling. I'm guessing.
Yeah. So when you showed is it PenSwap earlier, right?
Yeah, TimeSwap and PokerSwap.
Yeah. It's, okay. So in Nigeria, TapSwap became a crazy thing like 3 months ago, right? We were quite concerned at the central bank because we didn't understand this. There are people spending a lot of time playing. It was Telegram based game, and you had a lot of people playing on the TapSwap. So you have those kind of speculative use cases that we also observe over here.
Yeah, I saw that in Bhutan. There are lots of people mining crypto on their phone.
Yeah,
I think even central bankers were doing it. But yeah, it's a hard space to regulate efficiently. Even because even like non-scam projects, there's lots of scams, of course, but even non-scams can get hacked, or there can be a technical difficulty that could lead to catastrophic loss of funds. And it's really unlike a banking failure. It's really hard to crawl back the money. So it's really hard to take it back because once it's out into the international blockchain space, you can't take it back. So yeah, it's really hard to regulate effectively, especially because there's always new technology. There's new blockchains coming out, new types of layer 2s, layer 3s, different things like this. So I was wondering, do you have any kind of like a strategy to deal with this? So you mentioned, kind of comparing it to the Singapore regulatory approach, but I kind of feel like Nigeria is big enough. You're big enough of a market, especially compared to Singapore, where you could actually like do some kind of like a listing type of process where blockchain companies or crypto projects would apply to the central bank. You would do like basically a scam filter. You can't always guarantee the technology, but you can at least guarantee that obvious scams are filtered out. So like Ponzi's and things like that. Have you thought about that? Because you could actually take like a listing type of fee, which could generate revenue for the central bank.
So there, unfortunately, in a way, or for because of the legal structure, right? Listing is under the regulatory purview of the Securities and Exchange Commission, right? So if you saw around the second to the last slide, in 2022, the Securities and Exchange Commission in Nigeria created rules for issuance, offering, and custody of virtual assets, and they have the regulatory purview for listing, and they have the requirements. As you said, yes, there's a licensing fee. I think the review currently is looking at a listing fee for an exchange for around $1 million, right? Before then, it was seems to just like $50,000, right? But that was when the guidelines were put out in 2022. But the way the ecosystem has evolved rapidly, and the risk profile, they decided to review that upwards to like $1 million as the minimum capital for the listing for an issuer, if you want to issue a coin or you want to issue a particular asset. But yeah, so that's not really within the central bank. That's more within the Securities and Exchange Commission, and they've started work on that.
I see. Yeah, that's quite a high bar to pass. So uh, hopefully that can change. Otherwise, you do get like an underground type of unregulated economy. So I was wondering. So the speaker earlier from NICER mentioned that there's a kind of a lack of trust in fintechs, in fintech companies and fintech apps in Nigeria, just in general, because of scams, Ponzi schemes, like people taking money offshore and closing down, things like that. So, uh, like, how do you see this playing out in the cryptocurrency space? Do you also see an equal lack of trust that people have, or are they taking the risk and going into crypto assets because they see investment opportunity or something like that?
Okay. So I think first of all, just to clarify for what the previous speaker said, yeah, compared to traditional banks, right? Banks that have been existing, we have some banks in Nigeria that have been existing for over 130 years and all of that, right? So the level of they have a brand equity, they have some level of stability. Your granddad had a bank account with them, so the level of trust compared to maybe the fintech innovators is definitely higher. But the issues around market misconduct, which he alluded to, is something that the bank has been very aggressive with taming that. You have basically, um, yes, so someone raises money from venture capitalists to set up a fintech. They raise their Series A, their Series B, and they are unable to scale it properly, and then it shuts down. So the investors lose money. So yeah, that happens, but the level of trust has actually improved significantly because we've put a lot of regulations in place. Even now, we've extended deposit insurance to even fintechs. So if a fintech was shut down, yeah, you'll be able to get the customers will be able to have their deposits insured. So we've done that, but extending to crypto, the motivation for why people are getting into crypto is such that they are inherently aware of the risk, right? Because they know they're speculating, or they know that, oh, if I get in today, BTC is 92,000, I'm hoping it gets to 100,000. It could easily get back to 75. So they're very much aware. So that level of distrust isn't the same. But generally, the people who are not interacting with the crypto ecosystem, because we have 64 million unique bank account holders in Nigeria, right? But then we have around maybe 13 million people who use crypto or who say they use crypto. So it's still not even up to half of that banking population. So the people who are using crypto, they know, they understand the risks, and they are more comfortable with, they are more risk aggressive than maybe the traditional banking user. So yeah, we see those concerns, and it is why we've been proactively working with the Security and Exchange Commission to make rules around listing, around custody, around backing assets, just to be able to mitigate some of these concerns for entities that at least are within our jurisdiction.
Oh, that's a good comment. Actually, the people that we worked with at the Central Bank of Cambodia back in 2014, there are lots of crypto scams, and that's why they banned crypto. Um,
Yeah.
of course, you have to ask if it was uh, a good time to ban crypto since Bitcoin went from like $100 to like 90,000. But that's another topic. But they kind of saw that as a central bank, they saw that it's very resilient infrastructure, and that's why they wanted to use blockchain for Bakong.
Yeah.
I was wondering, I don't know too much about the current state of the ENIDA.
Yeah.
Is this using blockchain? And maybe you can talk a little bit about the future plans, or maybe it's outside your specialty. I don't know.
Okay, so yeah, I was on the ENIRA project, right? I was doing more of macroeconomic analysis with the research team, but yes, it's blockchain based. We use the Hyperledger Fabric, so it's built on the Hyperledger Fabric, and currently there's a review of the entire project because we towards the end of last year we had a change in the management of the bank, So all the governors, all the deputy governors were replaced. So the new guys are evaluating the project, and once the evaluation is completed, then they will decide on the direction to go. Because there are different objectives for why central banks, and you guys worked on the back end, and the deputy governor for payments for the Bank of Cambodia, we had some interactions with her when we were trying to build the INERA, and for them to say, for them, they wanted not just payments efficiency, but also considering some cross-border components for certain countries that are neighboring, like maybe Vietnam, Hong Kong, Malaysia, all of that. So for these new management, they would have to decide what their objectives are, for which they want to pursue it, and then maybe that would give a new direction to the project. But yeah, they're currently it's currently at a review stage, basically.
Yeah, my understanding is Nigeria is a very cash-based country, and the previous management wanted to reduce the use of cash, and that was one of the objectives. But yeah, I think that's exactly the right approach. You should have a problem first, and then you choose the technology that is used. So you want to have the best tool for the best job. Speaking of which, one of the people in the chat wrote about. Do you see central banks being replaced by DAOs and different kinds of smart contracts in the future?
No, I don't see that. I actually see central banks adopting. I see central banks adopting smart contracts for different use cases around wholesale payments to mitigate or to solve problems around liquidity risk, for instance. For wholesale payments, I see central banks being able to adopt that. We adopted smart contracts for programmable payments, right? On the INERA, we piloted that with some fintechs for lending, and I can see that even being extended to things like social transfers and social interventions using smart contracts to program payments for stimulus type payments, so that the central bank can easily be able to inject and withdraw liquidity into the system. So I see more of an adoption of DAOs, or most likely smart contracts by central banks, rather than a replacement, mainly because of the legal considerations. You try to repeal a central bank act. Even in China, one party state, it took close to 2 years to change the central banking act to be able to do the e-renminbi, right? So yeah, I don't see a replacement, but I see an adoption as time goes on.
I think that's a fair assessment. Yeah, so I think this is a very interesting topic. I think we're a little bit out of time, but I'll just mention quickly that in the Plow system, we also use smart contracts for the Plow savings bond system that I talked about this morning. I don't think you were online back then, but it's quite early in Nigeria that we started today. But all the videos will be online on YouTube, so please check it out when you have time. But we built a savings bond system for Plow, and we actually used Hidrohatu to generate smart contracts that pay the interest, the coupon payments automatically. So it reduces the back office burden. So this type of automation can help central banks quite a lot in the future, I think.
That's cool.
Can help with reconciliation too, as our second speaker today, Clément, talked about. There's often reconciliation problems between the different systems. Yeah. So yeah, thank you very much. I really appreciate your time. It's really amazing. And yeah, we'll go on now to the next speaker without
An ancient prophecy foretold an eclipse that would open a portal to a mystical world, the world of Soratopia, where honor, valor, and swords determine your fate. You can become one of them. Choose your path. Become a true samurai. Explore the vast world of Soratopia. Defeat mighty bosses in various locations. Your sword is your strength and honor. Don't worry, you're not alone. In Soratopia, you'll find loyal waifus to relax with. Engage in the game, pray, complete quests, and accumulate points to become eligible for a massive airdrop. Your path determines your destiny. Choose wisely. The eclipse has awakened, and so have you.